Hey everyone, welcome back to Market Meridian. If you're here because you're worried about your money, about inflation eating away your savings, about the next big economic crash, or about how to make sure you don't lose everything when things get messy, you're in the right place. Today, I'm breaking down two of the most important things you need to know right now, in plain English, no jargon, no fancy terms, just straight talk. We're talking about why gold is on track to hit $10,000 per ounce, and why 2026 could bring a crisis unlike anything we've seen since the 2008 financial crisis, maybe even worse. And most importantly, I'm going to tell you exactly what you can do to protect your wealth, your savings, and your family's future when this all goes down. First, let me make one thing clear, Market Meridian isn't in the business of fear-mongering. We don't make wild predictions to get clicks. We follow cycles, long-term patterns that have repeated throughout history, patterns that control how markets move, how currencies hold value, and how wealth is created or destroyed. Right now, three huge, powerful cycles are lining up together, and they're all pointing in the same direction, toward a period of massive economic change, and gold is the only asset that's built to survive, and even thrive, in that storm. So let's start with the first big question, why $10,000 gold? That number sounds crazy, right? I get it, if you're watching this, gold is probably around $5,000 or $6,000 per ounce right now, so $10,000 sounds like a stretch. But hear me out, this isn't a guess. It's what the cycles are telling us, and history proves it. Let's start with the longest cycle we follow, the Kondratiev wave, or the K-wave for short. Think of this as the granddaddy of all economic cycles. It's a 50 to 60-year cycle that goes through four phases: expansion, peak, recession, and depression. We're currently in the late recession phase of the fifth K-wave, and let me tell you what that means for you. In this phase, old growth engines, things like manufacturing, traditional energy, and even the US dollar as the world's reserve currency, are dying out. New growth engines, like green energy or AI, aren't ready to take over yet. So what happens? Most of the world gets stuck in a loop of slow growth, high inflation, and rising debt. It's like a car that's running out of gas, it sputters, it slows down, and eventually, it stops unless you fix it. And every single time we've been in this phase of the K-wave, gold has exploded in value. Let's go back to the 1970s. That was the last time we were in this late recession phase. Back then, gold went from around $35 per ounce to over $800 per ounce. That's almost a 20x increase. And here's the thing, the current setup is even bigger than the 1970s. Back then, central banks weren't printing trillions of dollars like they are now. Back then, global debt wasn't at an all-time high. Back then, we didn't have the geopolitical chaos we have today. So if gold jumped 20x in the 1970s, hitting $10,000 now isn't just possible, it's inevitable, if the cycles keep playing out the way they have for hundreds of years now. Let's move to the middle cycle, the credit cycle. This one is a bit shorter, usually 7 to 10 years, but it's just as powerful. The credit cycle is all about debt and money supply. For the past 15 years, central banks around the world, the Federal Reserve in the US, the European Central Bank, the Bank of Japan, have been printing money like there's no tomorrow. They call it quantitative easing or loose monetary policy, but in plain English, it's just printing more money to try to keep the economy afloat. When you print more money, the money you already have becomes less valuable. That's inflation, when your dollar buys less groceries, less gas, less of everything. And right now, the amount of money in circulation, what we call M2, is way higher than the actual growth of the economy. Let's put that in simple terms, if the economy grows by 2% in a year, but central banks print 10% more money, that extra 8% is just making your money worth less. The US debt alone is over $30 trillion, that's more than 120% of the entire US economy. Europe and Japan are even worse, Japan's debt is over 260% of its economy. That's like a person earning $50,000 a year but owing $130,000 on credit cards. It's unsustainable. And when debt gets that high, the only way governments can pay it back is by printing more money, which makes the problem even worse. This is the credit cycle collapsing, and when credit collapses, paper currencies lose their value. Gold, on the other hand, doesn't lose its value. It's been a store of value for thousands of years, from ancient civilizations to modern times. Gold has always been worth something. So when paper money becomes worthless, people rush to gold, and its price skyrockets. Now the third cycle, the geopolitical cycle. This is the shortest cycle, usually 3 to 5 years, but it's the one that's pushing things forward right now. Geopolitics is just a fancy word for countries fighting over power and resources. Right now, the world is more divided than it's been in decades. We have the Russia-Ukraine conflict dragging on, tensions in the Middle East, especially around the Strait of Hormuz, which I'll talk about later, and growing competition between the US and China. All of this is causing countries to rethink their reliance on the US dollar. For decades, the dollar has been the world's reserve currency. Countries use it to trade oil, to settle debts, to hold their savings. But in recent years, the US has used the dollar as a weapon, freezing other countries' dollar reserves, imposing sanctions, and cutting off access to the global financial system. That's made other countries nervous. They're asking, what if the US freezes our money too? So they're starting to move away from the dollar and toward gold. Central banks around the world are buying gold at a record pace. In 2023, central banks bought more gold than in any year since 1950. This isn't a short-term trend, it's a permanent shift. When countries stop using the dollar and start using gold, the demand for gold goes through the roof. And when demand goes up, prices go up too. Let's add one more piece to the gold puzzle: supply and demand. Gold mines around the world are producing less gold every year. For the past 5 years, global gold production has been declining. Why? Because the easy-to-mine gold is already gone. Now, miners have to dig deeper, spend more money, and take more risks to get gold out of the ground. So supply is going down. But demand is going up. Central banks are buying more, investors are buying more to protect their money, and even regular people are buying more as a hedge against inflation. When supply goes down and demand goes up, prices have to go up. It's basic economics. Now, some of you might be thinking, but gold had a dip last month, doesn't that mean the trend is over? No, it doesn't. Short-term dips are what we call noise in the cycle. Think of it like a roller coaster. The long-term trend is up, but there are small dips and turns along the way. In February of this year, gold fluctuated more than $100 per day for 12 days. That's a big dip, but it didn't change the long-term trend. The cycle is still pointing up, and gold is still on track to hit $10,000. So $10,000 isn't a wild prediction. It's the natural result of 3 cycles lining up, plus supply and demand working against paper currencies. Okay, now let's talk about the part everyone is worried about, the 2026 ultimate crisis. I need you to understand this isn't just a stock market crash. It's not just a recession. It's a collapse of multiple cycles at the same time: the debt cycle, the industrial cycle, the geopolitical cycle, and the growth cycle. All 4 are heading downward together, and that's what makes this crisis so dangerous. Let's break it down one by one. In simple terms, first, the debt cycle collapse. We already talked about how global debt is at an all-time high. But here's the trigger: the Strait of Hormuz. The Strait of Hormuz is a narrow waterway in the Middle East. It's where 1/3 of the world's oil is shipped through. If tensions there escalate, if there's a war, or if the strait is blocked, oil prices will skyrocket. Think $200 per barrel or more. Now, countries like Japan, South Korea, and India import almost all of their oil. To buy that oil, they need US dollars. And the easiest way for them to get US dollars is to sell the US Treasury bonds they hold. So if oil prices spike, these countries will start selling billions of dollars worth of US bonds. When everyone sells bonds at the same time, the price of bonds drops, and the yield, the interest rate on bonds, goes up. That's a problem because the US government has to pay interest on its debt. If yields go up, the government's interest payments go up, and they're already struggling to pay the interest they owe now. If interest payments get out of control, the US government could default on its debt. A US debt default would trigger a global financial meltdown, banks would fail, stock markets would crash, and currencies would collapse. This isn't a what-if scenario, it's a chain reaction that's already in motion, and 2026 is when it's likely to hit its breaking point. Second, the negative resonance of the geopolitical cycle and the industrial cycle. 2026 is expected to be a peak year for global conflict. The Russia-Ukraine war could escalate, tensions in the Middle East could boil over, and competition between the US and China could get worse. All of this chaos is breaking down global supply chains. Remember during the pandemic, when you couldn't find toilet paper or electronics? Imagine that, but worse, and for everything. Supply chains are already being shortened and regionalized. Countries are trying to make their own goods instead of relying on other countries. But this takes time and money, and it's causing prices to go up even more. Now, let's look at the industrial cycle in Western countries. For decades, Western economies have been moving away from manufacturing and towards services. Factories have been closed, jobs have been sent overseas, and now, Western countries don't make the things they need anymore. They rely on imports, which are getting more expensive because of supply chain issues and geopolitical tensions. At the same time, Western countries have too much debt, too little savings, and weak consumer spending. People can't afford to buy things, so businesses struggle, factories close, and unemployment goes up. This is the industrial cycle collapsing, and when it collides with the geopolitical cycle, it creates a perfect storm. In 2026, we could see large-scale business bankruptcies, soaring unemployment, and even social unrest in Western countries. This isn't fear, it's what happens when you ignore the cycles and let problems build up for decades. Third, the differentiation and collapse of the global growth cycle. Global economic growth is slowing down, and it's splitting into two parts, what we call a K-shaped recovery. On one side, some parts of Asia, like China, India, and Southeast Asia, are growing, thanks to green energy, digital innovation, and a growing middle class. They're building factories, investing in new technologies, and creating jobs. On the other side, Western developed economies, the US, Europe, Japan, are slowing down, even collapsing. They have too much debt, aging populations, and no new growth engines. This split is making the global economy more volatile. When one part of the world is struggling, it drags down the rest. For example, if the US goes into a deep recession, it will reduce demand for goods from Asia, which will slow down Asian growth too. This creates a negative cycle. Recession, less demand, slower growth, more recession. By 2026, this cycle could be in full swing, leading to a global recession that's worse than 2008. The 2008 crisis was just a collapse of the credit cycle. 2026 will be a collapse of 4 cycles at the same time. That's why we call it the ultimate crisis. Now, I know this all sounds scary. But here's the good news, you don't have to be a victim. You can protect your wealth, and even grow it, if you follow a simple, cycle-based plan. Market Meridian's core view is that a crisis isn't a risk, it's an opportunity. The key is to follow the cycles, not fight them. So let's talk about exactly what you can do to protect yourself. This plan is simple, actionable, and designed for ordinary people, not billionaires, not Wall Street analysts, just you and me. Let's break it down into 4 parts. First, core protection, precious metals. Gold is your foundation. It's the only asset that has survived every crisis in history, and it will survive this one too. I recommend that physical gold make up 5% to 15% of your investable assets. Now, when I say physical gold, I mean investment-grade gold bars or low-cost gold ETFs, exchange-traded funds. Don't buy expensive gold jewelry, it has high premiums, the extra cost for the design and craftsmanship, so you'll lose money if you ever need to sell it. Gold bars or ETFs are simple, low-cost, and easy to sell when you need to. Silver is also a good option, it's like gold's little brother. It's cheaper, so it's more accessible for people who don't have a lot of money to invest. Silver is more volatile than gold, which means its price goes up and down more, but that also means it can give you higher returns. I recommend silver make up 3% to 5% of your investable assets. Think of gold as your safe haven, it will protect your money, and silver as your growth play, it can give you extra returns when the cycle turns upward. Second, auxiliary protection, hard assets. Hard assets are physical things that hold value, even when paper money is worthless. We're talking about things like high-quality diamonds, luxury watches, and core real estate. Let's start with diamonds and luxury watches. These are small, easy to carry, and hold their value well. A high-quality diamond or a luxury watch, like a Rolex or Omega, can be sold almost anywhere in the world, even in a crisis. They're like emergency cash that you can carry in your pocket. I recommend allocating 2% to 3% of your investable assets to these kinds of scarce physical assets. Now, real estate, but not just any real estate. I'm talking about high-quality properties in core cities. Think New York, London, Tokyo, or major cities in Asia. These properties hold their value because there's always demand for them. People need places to live and work, even in a crisis. Avoid non-core properties in small towns or third-tier cities. Those will lose value when the industrial cycle collapses. I recommend allocating 10% to 15% of your investable assets to core real estate. Hard assets are important because they're tangible, you can touch them, hold them, and they don't depend on a bank or a government to have value. Third, aggressive protection, digital hard assets. Now, I know digital assets like Bitcoin can be scary for some people, but hear me out. Bitcoin is like digital gold, it's decentralized, which means no government or bank controls it. It's also unfreezable, no one can take it away from you, unlike your bank account or your stocks. In a crisis where banks fail or governments freeze assets, Bitcoin can be your escape. But here's the catch, Bitcoin is very volatile. Its price can go up or down 10% to 20% in a single day. That's why I only recommend allocating 3% to 5% of your investable assets to digital hard assets like Bitcoin. And most importantly, never keep your Bitcoin on an exchange, like Coinbase or Binance. Always transfer it to a non-custodial wallet, which is a digital wallet that only you control. If you keep it on an exchange, the exchange could freeze your account, or it could get hacked, and you could lose all your money. Digital hard assets are not for everyone. If you can't handle volatility, skip this part. But if you can handle a little risk, they can be a powerful tool to protect your wealth. Fourth, the key to diversification, offshore allocation. The old saying goes, don't put all your eggs in one basket. That's never been more true than right now. If you keep all your money in one country, you're vulnerable to currency depreciation, capital controls, or even government seizure. Offshore allocation means spreading your assets across different countries to reduce risk. If you can afford it, open an offshore bank account in a stable country like the United Arab Emirates, Turkey, or Singapore. These countries have strong banking systems, stable currencies, and no capital controls. You can transfer part of your money there to protect it from inflation or government interference. Another option is the hawala system. It's a traditional remittance method that's been used for centuries in the Middle East and South Asia. It's a way to send money internationally without going through banks, which can be useful if formal channels are cut off. But be careful, make sure you use a reputable hawala provider to avoid scams. Offshore allocation isn't just for the rich. Even if you have a small amount of money, spreading it across different countries can help protect you. The goal is to make sure that no matter what happens in your home country, you have money somewhere safe. Let me recap this plan to make sure it's clear. 5 to 15% gold, 3 to 5% silver, 2 to 3% scarce physical assets, diamonds, watches, 10 to 15% core real estate, 3 to 5% digital hard assets, and the rest in cash or other low-risk investments. This plan is balanced. It protects you from risk, but also gives you the chance to grow your wealth when the cycles turn upward. The core logic here is simple: own real things, not just paper money. Paper money can be printed into worthlessness, but real assets, gold, silver, diamonds, real estate, will always have value. Now, let's talk about why governments and central banks are making this crisis worse. I'm not here to bash governments, but I am here to tell you the truth. For the past 15 years, central banks and governments have been fighting against the cycles instead of working with them. They keep printing money to fix every problem, they keep spending more money than they have, and they keep ignoring the warning signs. This creates a deadly loop. The economy slows down, central banks print money, inflation goes up, central banks raise interest rates, the economy slows down even more, central banks print more money. It's like trying to put out a fire with gasoline, it only makes the problem worse. Let's take the Federal Reserve as an example. After the 2008 crisis, the Fed printed trillions of dollars to stimulate the economy. That worked for a while, but it created a bubble in the stock market and the housing market. Then, when inflation spiked a few years ago, the Fed raised interest rates to try to cool it down. But raising interest rates made it harder for people to pay their mortgages, harder for businesses to borrow money, and harder for the government to pay its debt. Now, the Fed is stuck. If it keeps raising rates, the economy will crash. If it cuts rates, inflation will spike again. This is the same mistake central banks made before the Great Depression and before the 2008 crisis. They think they can control the economy with money printing and interest rates, but they can't. The cycles are bigger than any central bank or government. By fighting the cycles, they're making the crisis worse and longer than it needs to be. Another problem is excessive government spending. Governments around the world are spending more money than they collect in taxes. They're spending money on wars, on welfare programs, on inefficient infrastructure projects, and they're borrowing money to do it. This adds to the national debt, which we already know is unsustainable. The New Deal, which pulled the US out of the Great Depression, worked because it focused on investing in people and infrastructure that actually created jobs and growth. But today's government spending is different, it's wasteful, it's not creating long-term growth, and it's only adding to the debt. This is a violation of the fiscal cycle. Government should spend money when the economy is down, but they should save money when the economy is up. Instead, they're spending money all the time, which is making the debt crisis worse. Market Meridian warns that the global economy's fragility is at an all-time high. The investment cycle is sluggish, businesses aren't investing in new projects because they're worried about the future. The fiscal cycle is imbalanced, governments are spending too much and saving too little. The geopolitical cycle is turbulent, countries are fighting, and there's no end in sight. The industrial cycle is in recession, Western economies are hollowed out, and they can't compete with emerging markets. All four cycles are in a downward spiral, and if something doesn't change soon, 2026 will be the year it all collapses. But here's the thing, you don't have to wait for governments to fix it. You can take control of your own wealth by following the cycle-based plan we talked about. Let's wrap this up with a quick recap, so you can take these key points with you. First, gold is heading to $10,000 because three cycles, the K-wave, the credit cycle, and the geopolitical cycle, are lining up, and supply and demand are pushing it higher. This isn't a guess, it's history repeating itself. Second, the 2026 ultimate crisis is a collapse of four cycles at the same time: debt, geopolitics, industry, and growth. It will be worse than 2008, but it's not inevitable for you. Third, you can protect your wealth with a simple plan: gold, silver, hard assets, digital assets, and offshore allocation. Own real things, not paper money. Fourth, governments and central banks are making the crisis worse by fighting the cycles, but you don't have to be a victim. You can take control. I want to leave you with this: Market Meridian never creates anxiety. We give you the truth of the cycles. Risks never come suddenly, they build up over time, and the cycles tell us when they're going to hit. The more you understand the cycles, the safer you are. The worst thing you can do is ignore the warning signs, bury your head in the sand, and hope everything will be okay. It won't. But the best thing you can do is take action now, even small steps. Buy a little gold, invest in a small piece of real estate, open a savings account in another country. Every small step you take now will protect you when the crisis hits. Now, I want to hear from you. Drop a comment below and tell me, do you think gold's big move to $10,000 will come before 2026? And what asset will you use to protect yourself first: gold, silver, real estate, or something else? I read every comment, and I'll respond to as many as I can. Also, make sure you subscribe to this channel and hit the bell icon. We'll keep updating you on the cycles, on gold prices, and on how to protect your wealth. We're in this together, and I'm here to help you every step of the way. Before we go, one last reminder, this is not financial advice. Everyone's situation is different, so you should talk to a licensed financial advisor before making any investment decisions. But the cycles don't lie, and the warning signs are clear. Take action now, and you'll be glad you did when 2026 rolls around. Thanks for watching, everyone. I'll see you in the next video.